Have you ever paused to think about the intricate, often invisible engines that genuinely power our global economy? We're not talking about the shiny new consumer apps or the tech gadgets everyone talks about. Instead, imagine a deeply complex, incredibly efficient world of business-to-business payments and data management, the kind of infrastructure that quietly underpins commerce, logistics, and even how huge companies manage their employee benefits. It's the silent orchestrator that keeps the gears turning. Today, we're peeling back the curtain on one of those critical orchestrators, WEX Inc., traded on the New York Stock Exchange as WX. This is a global commerce platform that countless businesses, from the smallest local delivery service to multinational corporations, rely on every single day. Even if the name WEX might not immediately jump out at you, think of them as the behind-the-scenes wizards, simplifying everything. From how a massive vehicle fleet manages its fuel consumption across entire continents, to how a large corporation streamlines its complex spending, and even how your own health benefits accounts are meticulously administered. Our mission for you today is to truly unpack this remarkably intricate company. We're going to dissect its three quite diverse business segments, that's mobility, corporate payments, and benefits, and then we'll dive deep into the strong bullish arguments and the equally significant bearish concerns swirling around its future. Our goal is that you'll walk away with a crystal clear, comprehensive picture of how WX operates, what precisely makes it such a formidable competitive force in its markets, and crucially, the significant challenges it faces, particularly with the unstoppable global rise of electric vehicles. Okay, let's unpack this. We've got a formidable stack of in-depth investment research analyses, SEC filings, and industry reports from a variety of sources. Our job is to extract those most important nuggets of knowledge, giving you a real shortcut to being thoroughly well-informed about WEX Inc. Think of it as your express lane to insight.
What's truly fascinating here, as you said, is how WEX has meticulously built this incredibly diversified business model from what was, at its core, a foundational payment processing platform. But here's the rub. It now finds itself at a genuinely pivotal moment. We're going to be looking closely at both its very established strengths, which are considerable and have driven its success for years, and the profound technological shifts that are clearly on its horizon. It's a classic business narrative, innovation meeting major disruption.
So let's begin at the very beginning. What is WEX Inc? They describe themselves as a global commerce platform, which sounds broad. But their core mission centers on simplifying complex payment and data management for businesses, making them essentially a robust business-to-business ecosystem. Can you elaborate on that core mission for us?
Absolutely. At its very heart, WEX's core mission boils down to simplifying the business of running a business. They achieve this through what they call personalized embedded solutions, which are all powered by their specialized expertise and, crucially, incredibly rich data. Think of it as providing the granular financial plumbing that allows other businesses to operate not just more smoothly, but more intelligently. And the essential element underpinning everything they do is their proprietary technology platform. This isn't just an IT system. It's purpose-built for high-volume, extremely reliable transaction processing, capable of operating across more than 20 currencies. This robust and highly scalable platform is precisely what allows WEX to embed its solutions so deeply into their clients' daily workflows, becoming an indispensable part of their operations, not just another vendor.
So that proprietary scalable technology platform really isn't just a buzzword then. It sounds like it's the absolute backbone of their entire operation. It feels like this deep integration must make them incredibly sticky, right?
Precisely. This deep integration is a critical competitive advantage for WEX. It means they're not just providing a service. They're woven into the very fabric of their customers' financial and operational processes. Imagine trying to rip out and replace the central nervous system of your business. It's a massive undertaking, right?
Yeah, no kidding.
This creates an incredibly data-rich ecosystem, which in turn leads to extremely sticky customer relationships. Businesses simply don't want to endure the cost, complexity, and risk of replacing a system that's so fundamental to their daily function. And this brings us to a key idea that truly defines WEX, its diversified model. The company is strategically structured around three distinct yet interconnected business pillars: mobility, corporate payments, and benefits. This diversification is central to WEX's operational resilience and provides multiple independent vectors for future growth, making the company less reliant on the fortunes of any single market.
So with that diversified structure, let's put on our investor hats. What's the most compelling argument for WEX right now? What truly excites a bullish investor, and is it a sustainable advantage?
Well, from a bullish perspective, there's a lot that should genuinely excite investors. Firstly, WEX holds established leadership positions in what are genuinely large and, importantly, expanding markets. They aren't chasing niche trends, they're playing in the big leagues. Secondly, a very high proportion of their revenue is recurring and transaction-based. This translates into incredibly strong and predictable cash flow generation, which is highly prized by investors because it gives the company a stable base to invest and grow. And thirdly, they possess significant competitive moats. These include strong network effects, meaning the more businesses that use WEX, the more valuable the network becomes to everyone, and also those high switching costs we just discussed.
Right, the stickiness factor.
Exactly. Once a business integrates WEX, it's a huge undertaking to move elsewhere. These factors collectively paint a picture of a robust, defensible business that generates substantial, reliable cash.
But every coin has two sides. While that bull case sounds solid, what are the counter-arguments, the bearish concerns that might keep an investor up at night when it comes to WEX?
This raises an important question, as no company, especially one of this size and complexity, is without its risks. While there's a strong bull case, we absolutely cannot ignore some very material challenges. Firstly, the company faces intense competition, and I mean intense, most notably from Corpay, formerly FleetCor.
Ah, yes, Corpay. They pop up everywhere in this space.
They do. And Corpay operates a very similar and highly acquisitive business model across many of the same segments, so direct, tough competition. Secondly, WEX is sensitive to macroeconomic factors. Fluctuations in fuel prices directly impact their mobility segment.
Which is the biggest part.
Right, and changes in interest rates affect both their funding costs and, interestingly, their revenue in the benefits segment. But arguably the most significant long-term challenge, the one that truly dominates the investment narrative, is the secular technological disruption from the global transition to electric vehicles, or EVs.
The elephant in the room.
Exactly. This directly threatens the traditional high-margin revenue model of their core mobility segment. Their pivot to capture value from EV charging is critical, absolutely critical, but its success remains a significant uncertainty for the market, creating a genuine question mark over their future growth.
Now that we've glimpsed WEX's overall blueprint, let's peel back the layers and dive into each of its three distinct segments, starting with the titan that truly built this company, mobility. This is the bedrock, the biggest piece of the pie, and it's where WEX began its journey, right?
That's precisely right. The mobility segment is indeed WEX's largest and most established business. It's what they're historically known for. It provides payment and transaction processing for vehicle fleets globally, meaning it helps businesses manage the costs associated with their vehicles, primarily fuel. This isn't just for massive corporations. They serve a remarkably diverse customer base, ranging from small businesses with just a few vehicles to enormous commercial and government fleets that number in the thousands. The scale here is truly substantial. For the first 9 months of 2024, this segment alone generated approximately $1.3 billion in revenue.
Wow, $1.3 billion.
Yeah, which represents over 65% of WEX's total revenue. It's the foundational engine of the entire company, and its performance significantly impacts the whole.
So how does WEX actually make money in this mobility segment? It sounds like it's more sophisticated than just selling fuel cards.
It definitely is a multifaceted revenue model designed for stickiness rather than relying on just one stream. WEX makes money in mobility primarily through three channels. First, you have standard payment processing fees. This is a fee WEX earns on each transaction, typically calculated as a percentage of the total purchase amount. So naturally, higher fuel prices or more gallons bought mean more revenue.
Makes sense.
Second, there's account servicing fees. These are recurring fees charged to customers for all the essential value-added services WEX provides, like detailed data reporting on fleet activity, account management tools, and other services that go beyond just the payment. These are generally stable and predictable revenue streams.
The value add.
Exactly. And third, they earn finance fees. This includes things like late fees charged on overdue customer accounts. The revenue from this source is influenced by factors like customer payment behavior, WEX's own credit policies, and, interestingly, fuel prices.
How so?
Because if fuel prices are higher, then outstanding receivable balances are larger, meaning late fees can also tick up potentially.
That breakdown makes total sense. And speaking of fuel, it brings up an interesting paradox in the mobility segment's recent performance. Total revenue was actually up 2% year over year, even with lower average domestic fuel prices for the first 9 months of 2024. How did WEX manage that magic trick?
That's where the crucial insight into WEX's pricing power comes in. While lower average domestic fuel prices were indeed a headwind, reducing the nominal dollar value of transactions, WEX still managed to grow this segment by 2%. The growth drivers were primarily higher rates achieved from favorable contract renewals, which speaks volumes about their market position and the positive impact from the Pazer acquisition.
So they're pushing price increases through successfully.
Seems like it, but here's the crucial inverse relationship we touched on. The net payment processing rate actually increased by a significant 10% over that same period. What this tells us is that when fuel prices are lower, it can reduce the overall dollar value of a transaction, but it can also simultaneously expand WEX's percentage-based margin on that transaction.
Oh, okay, I see.
This highlights serious leverage. Customers view WEX's services, its data, and its management tools as critical and indispensable. They're often less sensitive to a slight increase in WEX's percentage fee than they are to the immense cost, complexity, and risk of trying to switch providers entirely. That's serious leverage.
That really demonstrates how deeply embedded they are. Moving on to the second pillar, corporate payments. This segment sounds like it's tackling a completely different challenge, but still within that B2B payment space.
It does, but you're right, it's still fundamentally about simplifying business operations through more efficient payments. The corporate payment segment is all about streamlining and automating business-to-business payments for various corporate and travel expenses. This includes offering modern solutions like virtual cards, which are incredibly secure and flexible, embedded payment solutions directly within a client's existing software, and comprehensive accounts payable, or AP, automation platforms.
For getting rid of paper checks and manual process.
Well, pretty much. These services help businesses manage supplier payments, employee travel, and other corporate spending much more efficiently and with better data. In terms of scale, for the first 9 months of 2024, this segment generated approximately $377 million in revenue. So it's smaller than mobility, but a significant and growing part of the overall WEX business.
So how do these corporate payments generate revenue? Is it similar to the mobility segment's fee structure or something else entirely?
The revenue model here is a bit different, primarily driven by two sources. The main one is the net interchange rate.
Interchange, like credit card fees.
Sort of, yeah. It's essentially a fee WEX earns on the total purchase volume processed through their corporate payment platforms. Think of it as a small percentage of every dollar spent using their virtual cards or AP solutions. The higher the volume of payments, the more revenue WEX earns. The company also earns interest revenue on restricted cash balances that it temporarily holds for its clients.
The float.
Exactly. These are funds that clients deposit with WEX before they are disbursed as payments, and WEX can earn interest on those balances for the short period they are held. Now, looking at the performance dynamics for the first 9 months of 2024, this segment saw revenue grow by a solid 6% year over year. This growth was propelled by higher travel and corporate purchase volumes as business activity picked up post-pandemic, as well as the positive benefit of rising interest rates on those cash balances.
Okay, that makes sense.
However, if we zoom out for a moment, it's important to note that the third quarter of 2024 actually saw a 6% revenue decline in this segment.
Whoa. Why was that?
Management attributed this to a reduction in purchase volume, which indicates its sensitivity to broader business spending fluctuations and overall economic activity. Also, the net interchange rate itself can vary based on the specific mix of customers and the types of transactions being processed. Different industries or transaction sizes might carry slightly different rates, adding a layer of variability.
Now, the third segment, benefits. Sounds like a completely different world from fleet management and corporate payments. How does WEX generate revenue from administering health benefits? That seems like a very specific niche.
You're absolutely right. It's quite distinct, but it cleverly leverages WEX's core capabilities in payment processing and data management in a very unique way. The benefits segment is a rapidly growing software as a service, or SaaS, platform focused on employee benefits administration. Its sweet spot is consumer-directed healthcare accounts, particularly health savings accounts, or HSAs.
HSAs, okay. Those are becoming more popular.
Very much so. Now, what's critical here is that WEX Bank, an FDIC-insured industrial loan company, acts as the custodian for these HSA deposits. This industrial loan company status is a truly unique, subtle advantage because it allows WEX to operate almost like its own bank, earning interest on those massive HSA balances in a way many pure-play competitors simply can't.
So they hold the cash.
They hold the cash. For the first 9 months of 2024, this segment generated approximately $394 million in revenue, showing its increasing importance and growth to the overall company. The revenue streams here are twofold. First, there are recurring account servicing fees from the SaaS platform itself. These are predictable fees charged to employers for administering their benefits programs and the associated accounts.
Standard saucies.
Right, but here's where it gets really interesting and unique. The second and increasingly critical revenue stream is interest income. WEX earns this by investing the substantial and growing HSA deposit balances held by WEX Bank. Think about it. Millions, even billions of dollars sit in these accounts, and WEX can earn a return on that capital, which goes straight to their bottom line. The performance dynamics for the benefits segment have been a standout for WEX. For the first 9 months of 2024, it showed a robust 13% year-over-year revenue growth.
13%, that's strong.
It is. This impressive growth was primarily driven by an 11% increase in average HSA custodial cash assets, essentially, more money flowing into these accounts, and the significant positive impact of higher interest rates on the investment of those balances. While the average number of SaaS accounts only grew by a modest 1% over the same period, it means much of the growth came from increased assets within existing accounts and, crucially, a wider net interest margin, rather than just adding a massive number of new accounts. Stepping back, what's the broader implication here is that the HSA deposits held at WEX Bank provide a remarkably stable, low-cost funding source for WEX. This is a unique advantage. What's even more fascinating is that rising interest rates, which are often a headwind for WEX's broader business because they increase the cost of its variable rate debt.
Right, makes borrowing more expensive.
Exactly, are actually a significant tailwind for the benefits segment. They widen that net interest margin on the HSA deposits, which means more profit from those invested balances. This dynamic creates a natural partial hedge against interest rate risk for the overall company.
A hedge, okay. That's clever.
It's a structural advantage that's not available to many pure-play competitors without a similar banking charter, making WEX's consolidated earnings stream more resilient across different monetary policy cycles.
That is a pretty ingenious structural advantage. But does that make them too reliant on interest rate movements, or is it genuinely a net positive for their overall risk profile, considering it offsets other risks?
It's an excellent question that goes right to the heart of their diversified risk profile. While it does introduce sensitivity to interest rates for the benefits segment, the key is the offsetting nature you mentioned. When rates rise, WX's variable rate debt becomes more expensive and negative. But simultaneously, the benefits segment's interest income also rises a positive.
So they balance each other out somewhat?
Exactly. This isn't perfect, but it provides a significant built-in partial hedge that smooths out earnings volatility. It makes their overall business model more robust than if they were purely exposed to one side of the interest rate equation. It's about overall resilience.
I see. So what truly protects WEX from its rivals? What gives it those sustainable competitive advantages we heard about beyond just having that banking charter?
That's an excellent question because in such competitive markets, durability is key. WEX's competitive strength stems fundamentally from its integrated technology platform and the durable business characteristics it fosters. As we discussed, they operate a proprietary global commerce platform built specifically for high-volume, multi-currency transactions. Its ability to embed solutions deeply into customer workflows isn't just a feature, it's a strategic weapon. It creates powerful barriers to entry and strong loyalty. Beyond the platform itself, WEX benefits from several sustainable competitive advantages. First, let's talk about network effects.
Right, the more the merrier.
Exactly. Think of it like a social media platform. The more people who use it, the more valuable it becomes for everyone. For WEX, it means more gas stations accept their cards because so many fleets use them, which then attracts even more fleets. It's a self-reinforcing loop that builds an incredibly powerful defensible position in the mobility segment. Second, and equally powerful, are high switching costs.
We talked about this being woven into the fabric.
Precisely. Because WEX's solutions are so deeply integrated into a customer's core financial and operational processes, from accounting software to procurement systems, switching to a competitor isn't just an inconvenience, it's costly, complex, and fraught with risk. This leads to incredibly high customer retention, which provides a stable, predictable revenue base. Third, a significant portion of their revenue comes from a recurring revenue model derived from those ongoing transaction processing and account servicing fees, offering fantastic stability and visibility into future earnings. And then, specific to the benefits segment, we have the WEX Bank Advantage. That large and steadily growing HSA deposit base provides a very low-cost funding source, which is often overlooked but profoundly important. This structural advantage, coupled with the interest rate hedge we just discussed, creates unique cross-selling opportunities across WEX's diverse client base, further enhancing customer stickiness.
Connecting the dots across segments.
Yes. Finally, WEX has demonstrated genuine pricing power. Even in the face of headwinds like lower fuel prices, the mobility segment managed to grow revenue, explicitly offsetting negatives with higher rates from favorable contract renewals. This isn't the behavior of a commodity processor. It suggests WEX is viewed by its customers as an indispensable financial technology partner, one whose services are critical enough that they are willing to accept price increases rather than endure the disruption of switching.
That's a comprehensive set of defenses. It almost sounds like WEX is trying to be three different companies under one roof: a credit card processor, an HR tech platform, and a traditional fleet manager. That's quite the balancing act. Let's zoom out a bit. WEX operates in three huge markets. What do these markets look like on a broader scale, and who are they up against globally?
You've hit on a core truth about WEX. It's a multifaceted entity within massive, evolving markets, each undergoing significant transformation driven by technology. Starting with fleet management, it's a truly substantial global market, driven by businesses constantly seeking to enhance operational efficiency, improve driver safety, and control costs associated with fuel and maintenance. Estimates vary, but projections place this market at between $18 billion and $29 billion in 2022-2023, with compound annual growth rates ranging from a robust 10.6% to as high as 16% through the early 2030s.
Huge growth potential there.
Absolutely. The expansion of e-commerce, requiring more and more logistics and last-mile delivery, provides a powerful tailwind. However, the key disruption here is the transition to EVs, which is creating an entirely new, adjacent, addressable market for EV charging payment processing and energy management, which WEX estimates could be worth between $1.5 billion and $2 billion.
A threat, but also a new market to capture.
Potentially, yes. Next, corporate payments is an immense market, experiencing a massive shift from inefficient, paper-based processes like checks towards digital, automated, and embedded payment solutions. Key trends here include the soaring demand for real-time payments, the integration of payment capabilities directly into business software, what we call embedded finance, and a heightened focus on data analytics and fraud security. The sheer scale is mind-boggling. Cross-border B2B payments alone are projected to reach an astounding $250 trillion by 2027.
$250 trillion. Wow.
It's enormous. This isn't just a trend. It's a fundamental rewiring of how businesses interact financially. And finally, Benefits administration is another rapidly growing market, with a projected compound annual growth rate of over 10%. This growth is fueled by the increasing complexity and costs of healthcare, pushing employers to seek more effective technological solutions to manage benefits like HSAs. A dominant trend in this space is the application of artificial intelligence, or AI, for sophisticated data analytics and enhanced employee communication. A 2024 Mercer report highlighted that 85% of HR professionals plan to utilize AI for benefits functions, underscoring the critical importance of technological innovation in this field.
That paints a picture of massive evolving markets. So given that, who are the major players WEX is up against in these diverse landscapes?
The competitive benchmarking reveals a landscape with several formidable players. WEX's primary competitor and most direct rival is Corpay, formerly known as FleetCor.
There they are again.
Right. Both companies share a very similar history, having originated in specialized fleet cards before aggressively diversifying into the broader corporate payment space. Corpay operates across segments like fuel, corporate payments, lodging, and tolls, and is well known for its growth through acquisition strategy, making them a very agile and aggressive rival. In the mobility segment, WEX also competes with traditional fleet management companies, or FMCs, such as Element Fleet Management and ARI, which was acquired by Holman.
How are they different from WEX or Corpay?
These FMCs often offer a broader suite of services, including vehicle leasing, maintenance management, and even remarketing, in addition to fuel card programs. It's a wider but often more asset-heavy approach. When it comes to market positioning, WEX and Corpay are generally considered the leaders in the specialized fuel card and mobility payments niche, leveraging vast proprietary networks and advanced technology platforms. However, WEX's key differentiator, as we discussed, is its integrated benefits segment and its status as an industrial bank.
The WEX Bank Advantage.
Exactly, which provides unique cross-selling opportunities and a structural fund advantage that Corpay simply lacks. Element Fleet Management, while a leader, is the largest pure-play FMC globally, but its business model is more capital-intensive due to its focus on vehicle financing and leasing. This makes it a different type of competitor than the more transaction-focused WEX and Corpay. If we look at their diversification strategies, WEX has made a significant strategic commitment to the U.S. healthcare space through its benefits segment. This creates a unique ecosystem with deep synergies, particularly that low-cost funding derived from HSA deposits. However, it also exposes WEX to the immense complexity and regulatory uncertainty inherent in the U.S. healthcare system.
A potentially higher reward, but maybe higher risk too.
Could be. Corpay, in contrast, has focused its diversification efforts on adjacent B2B payment verticals like lodging, tolls, and broader accounts payable automation. This approach may offer fewer direct synergies, but represents a more straightforward expansion of its core competency in B2B payments, with less exposure to the unique regulatory risks of a single, highly regulated industry like healthcare.
You mentioned embedded finance earlier, and that term keeps coming up in the industry. What exactly does it mean for WEX, both as a huge opportunity and a potential threat? It sounds like a double-edged sword.
You're absolutely right. Embedded finance is key to understanding the future of payments, and it's definitely a double-edged sword for WEX. It refers to the seamless integration of financial services directly into non-financial software platforms. For WEX, this presents a significant opportunity. They can position their platform as the go-to payments as a service engine for a multitude of vertical software providers.
So they become the plumbing inside other software.
Precisely. Imagine logistics management software, travel booking platforms, or even niche industry-specific tools. WEX can power the payments within those systems, vastly expanding its market reach without having to build the entire customer-facing application. They are actively pursuing this with their embedded payments solution. The threat, however, is equally potent. These very same software platforms could decide to build their own payment capabilities in-house or, more likely, partner with other fintech providers.
Cutting WEX out, potentially.
Potentially, yes. This could disintermediate WEX from the end customer, turning their direct relationships into indirect ones, or worse, losing them altogether. Consequently, WEX's long-term success in corporate payments and arguably other areas will depend not just on direct sales to businesses, but critically on its ability to win this platform-level battle by forging essential technology partnerships with these vertical software providers. It's a race to become the underlying infrastructure for a whole new generation of business software.
That makes perfect sense. Let's get into the numbers. How has WEX performed historically, especially through recent economic turbulence, like the pandemic and the subsequent interest rate hikes? What does their track record tell us?
WEX has indeed navigated significant macroeconomic challenges, including the global pandemic, demonstrating the resilience of its recurring revenue model. A review of their historical performance from 2019 to 2023 shows a company that experienced a dip but then made a strong comeback. Regarding revenue growth, total revenue declined approximately 10% in 2020 to $1.56 billion, primarily due to the severe impact of COVID-19 on fleet activity and travel volumes.
Yeah, 2020 was rough for travel and transport.
Definitely. However, WEX showed a strong rebound, with revenue growing an impressive 27% in 2022 to $2.35 billion, and a further 8.4% in 2023 to $2.5 billion. For the full year 2024, revenue increased 3% to $2.63 billion. This consistent growth reflects both organic expansion within their existing segments and strategic contributions from acquisitions, showing their ability to recover and adapt. In terms of profitability trends, WEX consistently operates on a high-margin business model. Their gross margin has remained remarkably strong, standing at 72.0% for the last 12 months.
72% gross margin is quite high.
It is. While GAAP net income, that's generally accepted accounting principles net income, a standard measure can sometimes be volatile due to non-recurring items like acquisition costs or impairment charges. Their adjusted operating income really highlights the underlying profitability and operating leverage of their platform. For example, the GAAP operating income margin was 24.7% in the fourth quarter of 2024, which is a healthy figure for a company of its type. Finally, looking at returns on capital, the company's metrics reflect its strategic use of financial leverage. For the trailing 12 months, return on equity, or ROE, that's essentially how much profit they generate for each dollar of shareholder money, was a strong 22.19%.
22% ROE, solid.
Very solid. But the return on invested capital, or ROIC, which looks at all capital, including debt, was lower at 6.85%.
Okay, so quite a gap between ROE and ROIC.
Yeah, this significant spread tells us they're using a good amount of debt to amplify returns for shareholders, which can be great when things go well, but also adds a layer of risk.
That makes sense.
Yeah.
What about their debt? That's a big part of payment processing, as you mentioned earlier. How does their balance sheet look? And what about cash flow? Are they generating enough to cover everything?
Yes, WEX utilizes its balance sheet extensively to support its operations and to fund its growth strategy, which naturally leads to significant debt, but also crucially strong cash flow generation. As of the last 12 months, WEX carried approximately $5.44 billion in total debt.
$5.5 billion in debt. That's substantial.
It is. This results in a high debt-to-equity ratio of 5.56x, meaning for every dollar of shareholder equity, there's $5.56 in debt. Their interest coverage ratio, which measures their ability to meet interest payments, stood at 2.91x, meaning their earnings before interest and taxes are nearly 3 times their interest expense.
Okay, so they can cover it, but the leverage is high.
Exactly. This substantial leverage is definitely a key risk factor that requires continuous monitoring, especially in an environment of rising interest rates. However, it's important to note that as of September 30, 2024, the company has maintained compliance with all applicable financial maintenance covenants under its credit agreement, which is a good sign of responsible management. On the positive side, one of WEX's core strengths is its ability to generate substantial cash flow. For the 9 months ended September 30, 2024, the company generated $392.5 million in adjusted free cash flow.
Nearly $400 million in 9 months.
Yes, and this is a significant increase from the $335.4 million generated in the same period of the prior year, highlighting the growing efficiency of its operations. This robust and consistently growing cash flow provides WEX with the essential financial flexibility to service its debt obligations, invest in technological innovation and strategic acquisitions, and return capital to shareholders. It's the engine that powers their ability to adapt and grow despite the leverage.
So WEX has this impressive cash-generating ability. But the last few years have been economically wild. Interest rate hikes, fuel price volatility, lingering post-pandemic effects. How has WEX been impacted by all these recent developments from 2022 to 2024? It sounds like a constant balancing act.
This period has certainly been dynamic, shaped by a blend of strategic acquisitions, significant macroeconomic shifts, and even some targeted regulatory scrutiny. WEX has been quite active with strategic initiatives and acquisitions. They acquired Payzer, a field service management software provider, specifically to enhance their mobility offerings and deepen integration.
Trying to build that moat wider.
Exactly. They also acquired the remaining interest in Ascensus Health and Benefits, solidifying their position and capabilities within the growing benefits segment. These moves show a clear strategy to gain scale and embed their platform even deeper into specific industry verticals, trying to build even greater stickiness. Macroeconomic impacts have been a real mixed bag. On interest rates, it's been a double-edged sword. On one hand, the sharp rise in rates significantly increased their financing interest expense on variable rate debt, adding $36 million in costs for the first 9 months of 2024 compared to the prior year. That's a direct hit to profitability.
Ouch.
But on the other hand, those higher rates have been a major boon for the benefits segment, significantly boosting the interest revenue earned on the large, growing pool of HSA cash deposits held at WEX Bank.
Ah, the natural hedge in action.
Precisely. So one part of the business counteracted the other. Fuel prices also showed volatility. Lower average domestic fuel prices during 2024 were a revenue headwind for the mobility segment because payment processing revenue is partly a function of the dollar value of fuel purchased. However, this was effectively offset by a positive impact on the segment's net payment processing rate, which, as we discussed, can benefit from lower input costs while maintaining their percentage margin.
That pricing power again.
Yes. And then overall economic activity directly impacts transaction volumes. The corporate payments segment, for instance, experienced a 16% decrease in purchase volume in the third quarter of 2024, leading to a 6% revenue decline.
16% volume drop is significant.
It is, and management attributed this directly to softer business spending across their client base. This clearly shows their sensitivity to the broader economy. Finally, we've seen ongoing COVID-19 recovery patterns. The travel vertical within corporate payments benefited from a robust rebound in corporate travel. Conversely, the legacy fleet business continues to adapt to new work patterns like hybrid and remote work, which subtly alter historical driving habits and fuel consumption. It's a slow, ongoing adjustment that they constantly monitor.
The new normal impacting fleets.
Right. And it's important to mention regulatory issues. WEX Bank, their banking subsidiary, has come under increased oversight. On September 20th, 2023, WEX Bank entered into a consent order with the FDIC, requiring corrective actions to enhance its compliance management program.
A consent order from the FDIC.
That sounds serious.
It's definitely something to watch. While the company stated it doesn't expect a material effect, it's a significant compliance and reputational matter that needs close monitoring and could divert management attention.
So, with all these challenges and opportunities, how is WEX planning to grow from here? What's the strategic roadmap for the coming years? Essentially, they're trying to re-engineer their core business while it's still running. That sounds like walking a tightrope. How aggressive do you think they can realistically be in this pivot without disrupting their cash cow?
That's an astute observation. It truly is a tightrope walk. WEX is definitely be pursuing a multi-pronged strategy designed to leverage its integrated platform, innovate technologically, expand globally, and forge critical strategic partnerships. A central strategy is cross-selling and ecosystem development. Their global commerce platform is specifically designed to facilitate cross-selling between segments.
Selling more stuff to existing customers.
Basically, yes. Imagine them marketing corporate payment solutions to their existing fleet customers, or offering benefits administration to the employees of those same clients. The goal is to increase revenue per customer and, crucially, deepen client stickiness across their entire ecosystem. This allows for organic growth without always having to find brand new customers. They're also investing heavily in technology and product innovation. A key focus here is addressing the EV transition. Recognizing it as a long-term threat but also a massive opportunity, WEX is proactively developing a suite of products for mixed energy fleets, meaning fleets with both traditional internal combustion engine vehicles and EVs.
So catering to both old and new tech.
That's the idea. Initiatives include WEX EV Depot for secure on-site charging payments, a mobile app that helps drivers find chargers, and even solutions for reimbursing employees for at-home charging costs. Their aim is to remain an indispensable partner for fleet managers as they transition to EVs rather than being left behind. Beyond EVs, WEX is integrating artificial intelligence into its offerings to improve user experience and efficiency.
AI is everywhere now.
It is. For example, they've introduced an AI-powered claims tool for flexible spending account, or FSA, reimbursements in the benefits segment, which helps reduce friction for users and makes the process much smoother. International growth is another key pathway. While North America is their largest market, WEX operates in over 10 countries and is focused on expanding its presence in Europe and the Asia-Pacific region. This involves adapting products for local markets, such as the recent expansion of their mixed energy fleet solutions across Europe to support commercial EV adoption there, recognizing that different geographies have different needs.
Tailoring solutions globally.
Exactly. Lastly, partnerships and ecosystem development is crucial. WEX employs a partnership-led go-to-market strategy evidenced by long-term contract extensions with major partners like Enterprise Fleet Management and Circle K. They also continue to expand their network through new agreements, such as a 2025 partnership with BP for the Unify Fleet Fuel Card program. These deep, long-term relationships are a core component of WEX's competitive moat, making them harder to dislodge.
Beyond operations and strategy, how does WEX manage its money and return value to shareholders? What's their capital allocation strategy, especially with that significant debt load?
WEX's capital allocation strategy is quite disciplined, designed to strike a careful balance between investing for future growth and directly returning capital to shareholders, all supported by their strong free cash flow generation. Their allocation priorities involve a mix of strategic mergers and acquisitions to acquire new capabilities and scale, significant internal R&D and capital expenditures to drive organic growth and innovation across their platforms, and then returning capital to shareholders, primarily through a substantial share repurchase program.
Buying back their own stock.
Yes. It's worth noting they do not currently pay a common stock dividend, signaling that they believe reinvestment and share buybacks are the most effective ways to create value. Their share repurchase program is quite aggressive and signals strong management confidence. During the first 9 months of 2024, WEX deployed $543.6 million to repurchase 2.5 million shares of its common stock.
Over $500 million in buybacks in 9 months.
Yeah, it's significant. In September 2024, the board of directors authorized an amendment to the program, increasing the total authorization to $2.05 billion and extending it through December 31st, 2025. As of September 30th, 2024, approximately $1.07 billion remained available under this authorization.
So they have authorization for another $1 billion worth.
That's right. This large-scale program serves as a powerful signal from management that they believe the company's shares are trading below their intrinsic value, actively countering market concerns, especially around the EV transition. Financially, it's accretive to earnings per share, meaning it boosts the per-share earnings, which can support a higher stock price if fundamentals hold. They also have an active M&A track record. WEX has historically been an active acquirer, using M&A to enter new markets and add technological capabilities, as seen with Payzer and Ascensus. The successful integration of these acquisitions and the realization of synergies, meaning making sure 1 + 1 = more than 2, are key focuses for management and critical for long-term value creation.
Integration is always the tricky part with M&A.
It really is. Finally, balance sheet management is ongoing as they actively manage their capital structure to optimize their cost of capital and maintain financial flexibility, for instance, through offerings like a $550 million senior unsecured notes offering in February 2025, showing they are proactive about their debt.
If WEX is growing, expanding, and generating all this cash flow, with management even buying back shares, why does the market seem to be discounting it? Let's talk valuation. What's the disconnect here?
This is truly where the rubber meets the road, and it's the core of the investment debate. The current valuation reflects a market that is heavily weighing WEX's solid growth and profitability against significant long-term uncertainties. There's a notable discount compared to both its own historical averages and some peers, suggesting that bearish concerns are heavily influencing investor sentiment. If we look at historical multiples analysis, as of late 2025, WEX's trailing 12-month PE ratio is in the range of 21x to 23x.
Okay, 21 to 23 times earnings.
Right. This is substantially lower than its 10-year historical average PE, which has typically been in the 35x to 60x range, and has even experienced periods above 90x.
Wow, that's a big drop from historical levels.
It is. This compression clearly indicates that the market is assigning a significantly lower multiple to WEX's earnings than it has for most of the past decade, signaling a shift in perception. Their LTM EBITDA enterprise value to earnings before interest, taxes, depreciation, and amortization is around 5.7x to 7.0x, and PS, or price to sales, is about 2.2x to 2.5x. Now, in terms of peer benchmarking, WEX trades at a comparable LTM PE ratio to its primary competitor, Corpay, at around 21.5x versus Corpay's 22.0x. However,
always a however.
Yeah, right. WEX's forward PE, which is based on future earnings estimates, is significantly lower at approximately 10.2x compared to Corpay's 15.1x.
10 versus 15, what does that suggest?
Well, it suggests that the market either expects stronger earnings growth from Corpay or is applying a heavier discount to WEX due to perceived risks, maybe that EV risk. Also, Corpay operates with significantly lower leverage, with a debt to EBITDA of 2.7x versus WEX's much higher 6.0x, which definitely explains some of that difference.
Lower debt usually gets a higher multiple.
Generally, yes. Compared to Element Fleet Management, which has that capital-intensive leasing model, WEX trades at a lower PE as Element is around 27x, implying the market pays more for a pure-play fleet management leader despite the different business model. And as expected, WEX trades at a substantial discount to asset-light, high-margin payment networks like Visa, which commands a PE in the low 30s. This reflects WEX's higher capital intensity, credit risk, and generally lower margins compared to those network giants, which makes sense given their different business models.
So given all those numbers, what's really driving this compressed valuations market perception? It sounds like there's one big thing weighing on investors' minds.
The primary driver of this compressed valuation is undeniably the market's deep concern over the long-term viability and profitability of the mobility segment in the face of the electric vehicle transition. Investors appear skeptical of WEX's ability to replace the historically high-margin fuel transaction revenue with new, equally profitable EV charging streams. The undervaluation argument, or the bull case, posits that the market may be underappreciating several key factors: the strong growth and profitability of the corporate payments and benefits segments.
The other two legs of the stool.
Right. Also, the significant pricing power WEX has already demonstrated in its legacy fleet business, and the idea that the sum of the parts value of its diversified platform is actually greater than its current market price if you looked at each segment individually. Conversely, the justification argument, or the bear case, contends that the structural decline of the internal combustion engine fleet market is inevitable, and that replacing that high-margin revenue will be incredibly difficult, uncertain, and costly, thus justifying a permanently lower valuation multiple for the company.
So it really comes down to whether you believe they can pull off the EV pivot.
Ultimately, yes. Whether the current valuation is justified hinges entirely on management's ability to successfully execute its strategic pivot away from fossil fuels and into the new energy economy over the coming years. It's a very binary outlook for many investors, and their success in this transition will dictate how the market values them long term.
We've talked about the good, the bad, and the numbers. Now let's identify the specific risks that could trip WEX up. What are the minefields they need to navigate in the years ahead, beyond just the EV transition?
A comprehensive view absolutely requires understanding the multifaceted risks that span business, macroeconomic, operational, regulatory, and even ESG categories. Starting with business and macroeconomic risks, the competitive threats are immense. The market is highly competitive, especially from Corpay.
Back to Corpay.
Always. This could lead to sustained pricing pressure, margin reduction, and market share loss across both mobility and corporate payments. They're constantly fighting for market share. Then there's technology disruption, specifically the EV transition. This is, as we've stressed, the most profound long-term risk. It directly threatens the foundational revenue stream of the mobility segment. While WEX is investing heavily in EV charging solutions, its ability to pivot successfully and replace high-margin fuel revenue with new EV charging streams is uncertain but critical. This isn't just a small tweak, it's a fundamental reimagining of a core business. Macroeconomic sensitivity is another factor. WEX is a cyclical business. A recession or significant economic slowdown would likely reduce commercial fleet activity, decrease business travel, and potentially lower corporate spending on healthcare benefits, impacting all segments.
So an economic downturn hits them from multiple angles.
It certainly could. Also, fuel price and interest rate volatility pose direct exposure. High or volatile fuel prices affect mobility margins and credit risk, while interest rate fluctuations affect both the company's debt funding costs and the revenue generated from its HSA deposits in the benefits segment, making it a complex balancing act. Moving to operational and regulatory risks, credit and fraud risk is inherent. WEX extends credit to many small and mid-sized businesses, particularly in the cyclical trucking industry, making it exposed to credit risk. An economic downturn could significantly increase losses.
Especially with smaller businesses being more vulnerable.
Exactly. They're also a target for sophisticated fraud schemes, which could result in direct financial losses and reputational damage if not managed effectively. M&A execution and integration risk is high, as WEX's growth strategy relies heavily on acquisitions. Risks include overpaying, integration difficulties, merging different technologies and cultures, and failure to realize projected synergies.
The M&A graveyard is full of failed integrations.
Indeed. Finally, regulatory and compliance risk is ever present. They operate in highly regulated financial services, banking, and healthcare sectors. The FDIC consent order for WEX Bank in 2023 highlights this. Any failure to meet regulatory requirements could result in fines, sanctions, and operational restrictions, which are costly and damaging. And we can't ignore ESG-related risks. Given that a substantial portion of WEX's business involves facilitating the purchase of fossil fuels, the company faces increasing scrutiny from ESG, environmental, social, and governance investors and stakeholders.
So pressure from the environmental side.
Yes. This could, over time, impact its reputation, potentially increase its cost of capital, and limit its access to investment from ESG-mandated funds if they don't adapt effectively.
So who's steering this ship through all these challenges and opportunities? How strong is the leadership and corporate governance at WEX? Does the management team inspire confidence in their ability to execute this complex pivot?
The quality and strategic direction of leadership, coupled with a robust governance framework, are indeed critical for WEX's long-term prospects, especially given the monumental shifts they face. The leadership team is anchored by Melissa Smith, who serves as chair, CEO, and president. She's been with the company for over 25 years and has held the CEO position for more than 10 years, providing significant stability and a deep understanding of the company's operations and markets.
Long tenure, knows the business inside out.
Exactly. The broader executive team also boasts extensive backgrounds in technology, finance, and international operations, reflecting the diversified nature of the business and the specific expertise required across its segments. This is not a team new to the challenges. Regarding strategic vision and execution, WEX, under its current leadership, has successfully executed a significant strategic pivot in the past, evolving from a U.S.-focused fleet card provider into a global, multifaceted commerce platform with strong positions in corporate payments and benefits. Management has demonstrated a clear awareness of the key long-term threats, particularly the EV transition, and is actively investing in new products and technologies to address these challenges head-on.
So they've navigated big changes before.
They have. The ongoing execution of this EV strategy, along with the successful integration of recent acquisitions like Pazer and Ascensus, will be crucial tests of their ability to navigate this complex and evolving landscape. Their track record suggests capability, but the scale of the EV transition is unprecedented. In terms of corporate governance, WEX's practices are detailed in its annual proxy statements. Their compensation programs are meticulously designed to align the interests of the executive team with those of shareholders. For fiscal year 2024, a substantial 92% of the CEO's target total compensation was variable and at risk, meaning it's tied to performance, not just salary.
92% at risk. That's heavily performance-based.
Very much so. Furthermore, 100% of the CEO's long-term incentive awards were performance contingent, comprised of performance share units and market share units, directly tying executive pay to the company's financial results, strategic goals, and stock price performance. This structure provides a very strong incentive for management to focus on creating long-term shareholder value and successfully executing their strategy. Lastly, their communication and guidance to the investment community are consistent. They provide regular updates through quarterly earnings reports, conference calls, and investor presentations, offering financial guidance for upcoming periods. This transparency allows investors to measure performance against stated goals and maintain an accurate understanding of the company's strategy and outlook.
So after this deep dive, what does this all mean for you as someone looking to be well-informed about WEX Inc?
Well, if we connect this to the bigger picture, WEX presents a genuinely complex and nuanced story. You have a durable, cash-generative core business in mobility that is undoubtedly facing a profound technological shift with the EV transition. This is balanced by two faster-growing segments, corporate payments and benefits, each with their own distinct opportunities and challenges. The market's current discount, as reflected in its valuation multiples, is the central debate. It's a discount for perceived long-term risks versus its underlying strengths and current profitability. To recap the key takeaways, WEX's diversification into mobility, corporate payments, and especially the unique benefits segment provides a significant degree of resilience and multiple vectors for growth. Its competitive moats, including high switching costs, network effects, and the unique low-cost funding advantage from WEX Bank, are substantial and difficult for competitors to replicate.
Those defenses are real.
They are. The EV transition is indeed the elephant in the room, a major threat to its legacy revenue, but also a new addressable market that WEX is actively and proactively pursuing with strategic investments. The current valuation clearly reflects market skepticism about this transition, despite the company's strong cash flow generation and management's confidence, which is powerfully demonstrated through its aggressive share buyback program.
Actions speaking louder than words with the buybacks.
Perhaps. Ultimately, it's not a simple asset-light payment network like Visa, but it's certainly more complex and differentiated than a simple fleet card provider. It's a company in motion, trying to adapt a powerful legacy for a new future.
As you think about WEX Inc., consider this. In a world rapidly moving towards digital and electric, is WEX a dinosaur trying to learn to fly, or maybe a phoenix in the making, uniquely positioned to bridge the old and new economies through its diversified payment and data management platform? What stands out to you as the most crucial factor in its future success or failure?